So now we want to go through, we talked a little bit about stocks, a little bit about bonds. We want to take a little bit deeper dive into each of those and what those mean and how we can potentially look at using those in your own portfolio. Cash investments. Brian talked about this a little bit. So we all have cash that we put in the bank. And for the last 8 years, it's been a bit painful because what's happened in the last 8 years? We had the financial crisis, we had the fallout from the financial crisis. And what the US government and the Federal Reserve did was they dropped interest rates basically to zero. And so for cash investors who were just taking money and putting it in the bank, you were literally almost earning nothing. I think the average rate in December 2015 was about 0.05% that you were earning on savings. That's literally, you get your statement and you say, wow, I earned 12 cents last month. What am I going to do with that? And now, since then, interest rates have risen a little bit more. So cash investments, we're starting to see some interest in folks who are looking at where they're parking their cash and how they can be more efficient in doing that. So one of the ways that Brian mentioned was money market funds. So a money market fund is simply an aggregation of assets that are very short-term in nature. And so those might be short-term bonds, those might be CDs. Has everyone heard of a CD, certificate of deposit? Is another type of debt instrument that's issued by banks. You can go out to any bank and buy a CD. And typically they're very short-term in nature, but they can go out as long as 4 years. Right now we're seeing 1-year CDs at around 1.5%. And that's a lot higher than we've had in 8 years. So there are more opportunities to be more efficient with your cash versus just leaving it in the bank. You can purchase a money market fund, have very short-term liquid money that's sitting there in case you need it. So those are the cash investments.